Financial stress doesn't usually arrive as a sudden disaster. It builds quietly, one bill at a time. One paycheck that disappears a little faster than expected. One small expense that shouldn't feel like a problem, but somehow does. And for a lot of households, that stress never really turns off. Even when people are working, even when they're paying their bills, even when they're being careful. In a moment, I'll explain why that constant pressure isn't a personal failure, and why it makes sense once you understand how everyday money actually works now. For many Americans, financial stress feels like background noise. It's there when you wake up. It's there when you check your account. It's there when you try to relax. It might not be in crisis, but you never feel safe either. And that middle space is exhausting because it requires constant attention. Right now, financial stability doesn't mean being debt-free or wealthy. It means whether your life can absorb normal problems without everything tipping over. A car repair, a medical bill, a slower week at work. For a lot of households, those aren't rare emergencies anymore. They're expected. And when every normal problem has to go on a credit card, your nervous system never gets a break. Later, I'll explain what stability actually looks like in this environment, even if your income isn't high. Most people don't realize how much the rules changed quietly. Wages didn't keep up with housing. Healthcare got more expensive even with insurance. Childcare costs rose. Interest rates went up, while balances stayed the same. None of that shows up on your effort level. You can be disciplined, organized, and serious, and still feel like you're sliding backward. This is where people start blaming themselves. They assume they must be bad with money. But the math is often the real problem. Think about a normal month. Your paycheck hits your account, and there's a brief sense of relief. Not excitement, relief. You immediately start assigning money to things that are already waiting. Rent or mortgage, car payment, insurance, utilities, credit cards, student loans. Medical bills that don't follow a clean schedule. Before you've had time to plan, most of your income already belongs to someone else. Then something small happens. A prescription refill, higher utility bill, a tire issue, a few $100s that wipes out whatever space you thought you had. Now you're not thinking about progress. You're thinking about survival. This cycle repeats month after month, and it wears people down, not because they're careless, but because there's no margin. In a moment, I'll explain why being careful alone doesn't solve this anymore. For a long time, working full-time meant stability. If you paid your bills on time, you felt like you were doing okay. Today, full-time work often just means keeping up. Housing takes a much larger share of income than it used to. Transportation costs more. Insurance premiums quietly rise every year. Healthcare shows up unpredictably. When most of your income is locked into fixed costs, flexibility disappears. Without flexibility, every small problem feels huge. This is why budgeting can feel frustrating. Budgeting helps you see the numbers, but it can't create breathing room when everything is already committed. You can do everything right and still feel trapped. Now let's talk about credit cards, because they sit at the center of this stress for many households. Credit cards often start as a solution. They help smooth gaps. They help handle emergencies. They help you keep going when costs rise faster than pay. At first, they feel helpful and responsible. Over time, they become pressure. Most credit cards today carry interest rates in the 20 to 30% range. That interest doesn't feel aggressive. It doesn't announce itself. It just quietly works in the background. Here's a simple example. If you carry a $5,000 balance at 24% interest, your minimum payment might be around $150. You pay it every month on time, you don't miss. You feel responsible. But early on, only a small portion of that payment goes toward the balance. The rest is interest. If nothing changes, that debt can take decades to clear. That's not a motivation problem. That's how the math is designed. In a moment, I'll explain why this connects directly to credit scores and why people feel especially stuck there. Credit scores make financial stress feel personal. Your score isn't measuring how hard you try, it's measuring risk. Payment history is the largest factor, roughly 1/3 of your score. Paying on time matters because late payments signal instability. That's why even one missed payment can drop a score far more than people expect. But here's the confusing part. Paying on time mostly protects you from damage. It doesn't automatically move your score up if other risk signals stay high. Credit utilization is another major factor. This is how much of your available credit you're using. If you have a $2,000 limit and a $1,000 balance, that's 50% utilization. Even with perfect payment history, that level can hold your score down. If you get that balance under $600, your utilization drops to 30%, and your score can move without any other changes. This is why people feel like they're doing everything right and still not seeing results. Effort doesn't matter here, positioning does. This is where most people accidentally make things worse by spreading money thinly instead of reducing pressure points. Later, I'll show you what actually helps without overwhelm. Another piece people don't talk about enough is income. Willpower does not beat math. If your income barely covers your bills, discipline alone won't create stability. You can cut small expenses, track every dollar, and still have no margin. This is why income matters more than motivation, not flashy income, not risky income. So boring, predictable income. Side hustles get sold like shortcuts, and that's where people get hurt. Fast money usually comes with fast stress, scams, hype, volatility. Stability comes from income that stacks quietly. An extra $200 or $300 a month can change everything because it creates breathing room. Think about what that does. It can keep a bill off a card. It can knock a balance below a utilization threshold. It can stop one problem from turning into 5. This is where people chase big wins instead of small relief and end up more stressed. Financial stress today isn't about being irresponsible. It's about living in a system with very little forgiveness. One mistake echoes for months, sometimes years. The goal isn't perfection, it's margin. Today, the most important thing is to stop new damage, not optimize, not plan perfectly. Just protect yourself. It might mean automating minimum payments so nothing goes late. It might mean avoiding new balances where possible. Small moves, but they reduce pressure immediately. This week is about clarity, knowing which balances hurt you most, knowing your due dates, knowing where your money actually goes. Clarity lowers anxiety before money changes. This month is about adding one layer of stability. One, that might mean slightly increasing income in a boring legal way. Extra shifts. Freelance work you already know how to do. Or it might mean paying down one balance enough to cross a utilization line. Financial repair is slow. That's not a flaw. It's protection. Stability builds quietly. One day you realize you're not panicking anymore. If this sounds familiar, send this to someone who works hard and still feels stuck. You are not behind. You're responding to a harder environment with limited tools. As you add better tools, things change. Slowly, calmly, and that's enough for now.